Ladies and gentlemen, welcome back to the next part of the correlation section. You won't even be able to tell this because obviously you'll have just finished the last video and started this one, and you'll think, hey, Envy's probably taken a day off and he's come back and he's cracking on here, because you're probably doing the same, even though I did suggest taking time to really let what I said in the last session settle in. Anyway, the point is that you might be thinking, it's been a day since I recorded the last session on all the correlation where I did all the statistical analysis and I showed you a lot of the theory about what correlation is, covariance, and how you compare the variances and how the variances interrelate to each other, and that gives us a strength of a relationship. The truth is, it's been about 2 months since I recorded that. You might say this is all irrelevant, what I'm about to tell you, but hey, you know how I am. I'm just the same as everyone else. I'm just a normal guy, so I like to share these things with you. So just humour me. But basically, I think I said in the last section, I had a little bit of a gap because my grandmother passed away and I had a few things going on. It is what it is. It happens to everyone. I get it. Don't want no special sympathies or treatment. I'm just saying that there was a gap there. I've now had another 2-month gap. And I think part of it was that I'm getting married, basically in about 2-3 weeks. I'm getting married, and yep, that's how important you guys are. That guys and girls, both of you, everyone is. That's how important everyone is to me. That I'm going to spend time doing this because I want to finish it. Because you know how it is. Once you get married, and obviously who knows where that will take me. I'm just joking. Obviously. You'll still be seeing lots of me, but rather than delay any further, you know what I mean, it could be months before I end up finishing this. I really wanted to do this, but I also realized how much the fundamentals course has taken out of me, which is a good thing, and I hope you feel that you've got 10 times more value than obviously what you paid for the course, because I am really giving it 1,000% to get this far. And again, I'm not looking for sympathy. In fact, the opposite. What I'm saying to you is, take your time. You see how I've taken my time to build this course. And I've taken some big breaks because it's taken so much out of me. And I'm not even on the learning end. I mean, heaven knows what it must be like for you. Because I did actually go back and watch the last section just to catch up, refresh my memory where we left off in that correlation, covariance, statistical section. Because obviously it has been a couple of months, and I just want to make sure that the continuation is smooth. And I was watching it back, and I actually really enjoyed it. And I thought it was really, really good. I thought it was explained very well. I'm happy with that section, very, very happy. But I just realised that it's very heavy going, all of this. This taken me a couple of decades to really collate all this information together. So my point is, why rush it? You will get there. You can see, and hopefully you agree with me, you're getting the very best education. So take your time. Don't rush it. As said in the last section, take as long as you need. Watch it a few times. So what I'm going to do, in fact, you'll see here, I've got something slightly different in front of me. You'll be happy to see this. No more spreadsheets for a while. I realized rather than do more theory, I said I would talk a little bit about why certain correlations exist, and we can have a little brief chat about that. I said before, personally, we're here to learn, or we're here to trade, right? We're not here to, and I mean this in the politest way, we're not here to learn how to get a job on CNBC or Bloomberg, right? And there's nothing wrong with that. If you want to be a journalist, do it. Fantastic career. But you're not putting your money on the line. You're looking for reasons attributable to why the markets moved the way they did, right? We're not really, if you think about it, let's be honest here. I don't really care why crude oil, for example, and the S&P have a correlation. It's not really going to help me in the grand scheme of things. What I care about is that there is a correlation, they're moving together or against each other or not at all. Obviously, it could be no correlation. And I need to figure out how I can take advantage of that. The reasons behind that, as I'll explain later, are kind of irrelevant, right? And if you think about it, I'll give you a hint why. It's not, some of you may be thinking, well, Envy, if you know the reasons, maybe you could track those reasons. Actually not, okay? If you think about it, part of the issue that you have is something called idiosyncratic factor, or factors, I should say. Idiosyncratic. Okay, sorry, my handwriting is terrible. Idiosyncratic, okay? That means factors, very specific factors, I don't know why I took that off, very specific factors related to the asset classes themselves. So here you've got 10-year treasury, here you've got dollar yen, and here you've got crude oil. We're going to have a look at this in a lot of detail, right? Amazing session coming up. In fact, just really excited to show this to you. Very, very powerful this will be and helpful for your trading. And as you can see, it's very practical, this session. As I said before, I want to get a little bit more hands-on now, move away a little bit from the theory, really get you, that's why we're here. We're here to make money. As I said before, we're not here to get a job on Bloomberg, CNBC. And I said it before, obviously it's not a bad thing. It's just, obviously, we've got to be mindful of why we're here. We're here to obviously improve our trading. Now, idiosyncratic factors are factors that are very specific to each market. Think about it. Crude oil is going to be affected heavily by factors of production, okay? How do you extract that from other factors that are also affecting crude but now affecting other markets? So non-idiosyncratic factors. Things that cause correlation. This is why I'm really not that, I'm going to be honest with you, I'm really not that bothered about macroeconomic factors that are causing correlation unless I see huge kind of risk appetite or risk aversion across the board. Okay, and generally you're not going to get like 90% correlation. You're going to see today, you're going to get very good correlation. It's going to be more like 60%. Therefore, a lot of factors. Why is it not 100%? Why is correlation not 100%? Because it's not the same factors driving all the markets. Okay, and we can talk a little bit about that later when we discuss about what drives correlation, but I'm kind of hinting at it now. Idiosyncratic factors that are driving the crude oil market, they're not going to be driving the S&P 500. So that's why you're going to get these factors that are pushing crude oil around, but they're not having any impact on the S&P 500. So can you see that's going to reduce the correlation, right? Think of the scatter plot. It's going to make the scatter plot that I talked about in the last section, let's say you've got this kind of positive correlation. Idiosyncratic factors, do you see, very specific. Let's say this is crude oil and that is the S&P, and something happens in the crude oil market, something to do with OPEC or some factors of production, for example, on the supply side. Do you see? Crude might just jump, but S&P might stay there. Do you see that's going to impact, the correlation is going to drive it down, right? How do you separate that factor from a different factor that might be driving both? Do you see it starts to become incredibly complex? It becomes a minefield. So, as a trader, the reason why I'm saying all of this to you, and in fact, you'll be glad to know this, I'm trying to help you, is, sometimes I find fundamental traders make their life 10 times more difficult than they have to. Do you see, you don't kind of understand the limitations of how these things are going to help you, and just be on the edge of that at all times if you can. Try not to go too crazy with a lot of this stuff. I hear a lot of people say to me, oh, Envy, I've got to be following this macro thing and that macro thing, and before you know it, it just starts to actually become an impediment. Can you see? And coming back to the initial point, these idiosyncratic factors are very hard to break apart, right? You can't, on any given day, you might have some idiosyncratic factors affecting a market, crude oil, for example, but to what extent? How do you even know? It's so qualitative. How do you know how much some factors of production that are affecting crude oil, or even dollar yen? Let's think about dollar yen. We could have something in Japanese monetary policy, Japanese economy. You see, that isn't really going to impact the S&P, which is heavily correlated to what? The US economy. But it's going to drive dollar yen. Do you see? So how do you break that apart? Can you see the problem with starting to get to... Hopefully you can see why I gave you this little talk, and sometimes I do go on a little bit, but hopefully you can see it is for your benefit. Because who else is going to tell you this stuff? I don't hear anyone talking about this, but these are the sort of things, obviously, you know, when I was in investment banking and we were using correlation heavily, the discussions I would be having with my clients, would be talking about these factors and deciding, you know, is it really worth, well, is you know, this correlation really attributable to these type of factors? And I started realizing very early on in my career how difficult it was to split these factors out. How do you really split out, you know, Japanese specific economic factors from dollar yen and then say to yourself, right, okay, that much wasn't really driving both dollar yen and S&P, so I'm going to ignore that, but actually this other factor wasn't. Do you see, it becomes very messy? Why not keep it simple and just actually look at what is in front of you, which is the correlation, basically, and the extent. And look, that is exactly what we're here to do, okay? And you're going to be very happy and very excited to show you this, that we have some amazing tools on institutional platforms to do this for us. And actually, all they are is an extension of all the stuff I showed you in the last section, okay? So what I'm going to do, let me just get rid of that, is I'm going to actually show you how the stuff we went, and you're going to understand now why we spent so much time in the last section doing this, all these measurements in one number, correlation. This number, I actually plot it on my institutional platform, Sierra chart, which you see here. You can see it here, correlation coefficient, okay, it's that, 0.96, you can see it goes up and down, okay, so you can see it's really exciting because I'm actually going to show you how I utilize this in my trading, how I actually make money. I'm going to see some of my live trading, as in some of the my live fills, actual executions that I've done, and I'm going to show you some real examples of where I've actually traded in the market and how I've utilized correlation. So I'm going to show you that in a moment, but first I just want to have a tiny recap, right, of the last section, because I did ask you take some time out. The last section was very heavy going in terms of the statistics and so on and so forth. So let's just remind ourselves, right, of what we did. We had the covariance of two factors, right, so A and B, okay, over the standard deviation of A, standard deviation of B, okay. Now those two factors, they can be anything, right? We're looking for the relationship. So again, you've been through all of this. It was around 2.5 hours, so don't worry, I'm not going to repeat any of it. I even showed you how to calculate all of it. It can be, you know, what did we have here? We had temperature, and then we had ice cream sales. Okay, and then those two factors could be anything. I said that before. Could be the S&P and crude oil. And then what are we doing? We're plotting outcomes, basically, right, on a chart. So with this, it was ice cream sales versus temperature. Obviously, we said when the temperature goes up, ice cream sales also go up, which we would typically expect. Now, in terms of, and by the way, I'm going to look up quite a bit. Just want to make sure I'm not blocking anything. In terms of the relationship, we want to see how they co-vary together. Why is that? Because we want to see whether they're moving in a similar manner, right? So to do that, we need to have a benchmark against which they are moving against. So I explained this in the last section, the mean, the average. Okay, that is a static benchmark. Now I did notice, and I do apologize, and I'm going to say this now, probably could have not mentioned it and no one would have noticed, but I like things to be 100% perfect. You'll have to forgive me, I was watching the last section and I was saying, look, the temperature, if obviously you plotted it, you know, could be up here, could be down there, whatever. For some reason, I drew the line like that when I said, you know, we vary to the mean. Now, obviously, the mean is static, okay? You'll have to forgive me. I don't know why I was drawing it as an angled line. It isn't, right? So 19, for example, will be a static line like that, okay? And we want to see how much of these individual points vary, because it gives us a benchmark to compare what? Ice cream sales against. So how much does the temperature vary against this benchmark, right? So 14 is quite a low number. So would you agree? It varies by a negative amount versus the benchmark of 19 right here. The same time that that 14 happens, what happens to ice cream sales? Are they above or below their benchmark? What's their benchmark? 402. 402. Oh, look at that. Very low, right? So it might be plotted like this, and as I said I said it before, right? In the last section, I said go and watch the pro course. I've described variance and standard deviation a lot. So I said 215, which is somewhere down here, right? So do you see 14 is miles off negative versus the benchmark 19? At the same time, temperature is miles off its benchmark 402 negative. What does that mean? They're both moving in the same direction at the same time. Correlation, positive. Okay, simple as that. So I just wanted to do a little recap, and then obviously just apologize. I was, for some reason, I don't know where my head was at. I think I was focusing so long, talking for hours about the same thing. Sometimes obviously your head can lose its space a little bit. A very small fact, a small matter, it doesn't matter. But basically that is this, these two are the mean straight lines, and then when we compare these outliers, you see how much does that vary, and when you put them together, co-vary. That's where you get the word covariance, right? So covariance of the two of them together is 5325, and then as we said, divide that by the sum of the standard deviations, which is 5561, equals 96%. So they covary 96%. Why have I just gone over this? Because essentially, we've got some options now, okay? What we can do, so now we're going to have a look at the charts. And don't worry, all of this, I'm going to give you the template for this, okay? For Sierra chart, assuming that you use Sierra chart. If not, obviously you can use your own platform, and it's just correlation, okay? And I'll show you exactly what I've done here. Excuse me. Now, I like to focus, okay, I trade personally, virtually 100% of the time, the S&P 500. As a lot of you know, especially when I built Pro and Foundation course, I have traded other asset classes, of course, crude oil, FX, and for one reason or another, you know, I'm focusing heavily on the S&P 500, and I'm reaping the benefits of that. It means I'm just becoming the best at one thing, watching it every day, becoming at one with it, really enjoying that, allowing me more kind of work-life balance as well, not having to follow so many markets, multiple reasons, but you know, nothing to do with this section, right? But the point is, that is what I'm doing. So for your purposes, it might be slightly different, and obviously you can compare different markets, but the principles are the same. So what I'm doing is I am trading the S&P 500, right? So I am comparing the S&P 500 to other asset classes in the marketplace. So I personally like to look at dollar yen, okay? This is from experience, okay? You can try gold, you can try, you know, other commodities, you can try many different assets, other FX pairs if you want. What I have found over time, and obviously this is from my observances as well, working in institutions, so obviously you're paying for that experience, and I'm telling you, but nothing wrong with you experimenting for yourself. But I have found over the years the best correlations, you know, the strongest relationships between the S&P 500 exist comparatively to crude oil. What that means is other institutional traders are watching these markets, other equity institutional traders and crude oil traders and FX traders, they're pretty much watching these 3 or 4 markets for relationships, and their relationships tend to be the strongest. That is what I found. So S&P versus crude oil versus dollar yen. Okay, sorry, my spelling is awful. And then treasuries, 10-year treasuries. Typically it tends to be the yield, okay, on treasuries, interest rates essentially. And And if you're a crude oil trader, then compare crude to, just do it the other way around. Compare crude to the S&P, crude to dollar yen, crude to treasuries, and so on and so forth. So these are the three markets, right, I like to look at. And you'll see them here. And I'm going to give you the template for all of this, so don't worry. The point is, we've now got options. We can, and I kind of hinted at this before, what we can do, I'm sorry, I might be covering some of this, is we can start to plot crude oil and the E-mini S&P. Now I should have said this before, but it's kind of accepted convention in the statistical community that the independent variable goes here in the x-axis and the dependent variable goes here in the y. But the thing is, as I've said before, it's very hard to know which market is driving which, so that's why I haven't made a point of it. But if you've done your own research on statistics and you're looking at some statistical forums, I just want to acknowledge that. I get it. Before anyone says AMV, X should be the independent and so on and so forth. So that would typically mean S&P is driving crude. But as I said before, I typically find it to be the other way around, because I think I said that in the last section, because crude oil is so volatile, I tend to find that, or just from my experience of talking to other institutional traders and algorithmic traders, so people who develop algorithms, a lot of algorithms will be kind of connected to crude and what crude is doing, and then play some arbitrage in the S&P market and look for that relationship. So there tends to be quite more of a relationship from crude to S&P, but it's very hard to say. Okay, and again, for the reasons I talked about before, idiosyncratic factors, it's hard to break all the factors apart. You're going to get yourself into a minefield. It doesn't matter which way around you look at it, but I just wanted to mention that because obviously in statistics they do that. But look, back to the point. The point is, we now have options. You can either sit there and every single time you get new data on the S&P, right? So let's say this is the S&P. Just make sure I'm not covering anything. No. Every time you get new data on the S&P, you plot it and then you compare it. So let's say the S&P, I don't know, where's the S&P right now? Let's say the S&P was at anyway, just pick a number here. So this is the S&P, 3,900. Crude oil is at about 101, right? So I haven't actually got it here, but let's imagine it was here, plotted 3,900, and then this was 101. Do you see? You plot it, and then every single, you decide. You can get as granular as you want. Every single 10 minutes, or 1 hour, day, whatever, you just keep plotting this relationship, and eventually you'll have a bunch of a scatter plot, basically like this. Can you imagine doing this every 10 minutes, or however long you do, every hour, for example, every day, 24 hours a day, and then against all these markets, and then doing this calculation, putting it in a spreadsheet, calculating the variances, and then, as I said just before, comparing them to the averages, right, and seeing how they vary. We talked about this a million times, against their benchmarks, then seeing how those variances co-vary, then comparing them to the sum of standard deviations, and then saying, oh, this is by the time you've done all this, the market's going to move again. Can you see? You'll drive yourself crazy just to come up with what? One number. So what I have done, okay, is I have put this, and look, end of the day, I didn't invent correlation, right? So, I didn't invent any of this, okay? But at the end of the day, I'm just utilizing it. But what I have done is I've put it together in a way that I think just allows interpretation, like real solid interpretation, And I'm going to say it, because I always do say it, but I'm going to say it in a more of a polite manner than maybe I said in the Pro Foundation course. Can you see why a lot of the stuff you see, not only, to be fair, not only in the commercial retail sector, but also sometimes in the institutional sector, I've seen it, a lot of nonsense really, about this driving markets, that, all of that, it's just random garble. It doesn't make any sense. It's just, I don't know what it is, the stuff that people look at with all those lines and everything. Can you see this is actually what is driving markets? Interrelationships, divergences between two asset classes that typically are interrelated, and then institutional players will see that and try to bring them back together. Do you see? That is what is really driving markets, or because that creates opportunity, right? If, for example, crude and S&P are very close together and suddenly there's a disparity, that creates an opportunity. An institution will see that and say, hey, I think one is cheap, one is expensive. How? Because they now have a benchmark. Oh, it's moved versus this other asset. Do you see? It gives them almost like, obviously I talk a lot about volume profile, market profile, giving you a sense of value. This gives them another benchmark of value. Okay, it is exactly the same thing, right? Instead of looking at it on a, micro basis, like specific to the market, obviously if you're trading the S&P, you're going to try and find value relative to where the volume has taken place in the S&P. Now what you're doing is you're looking at, and then you're going to look for disparities, aren't you? In a rotational market, you might see the market move away from where the major volume is, and then you expect it to come back, right? It starts to become cheap or expensive. Same way, these markets will start to break apart, and people will look at opportunities of either, they're going to continue breaking apart based on structural issues or whatever, or there's an opportunity for them to come back together. Okay, that is why this stuff is so important for you to know. It is so crucial to your trading that you at least have some basic understanding of it. Okay, and is one of the major reasons I want you to see why a lot of these random things people tell you drive markets, it's kind of laughable, really, right? This is serious stuff now. So anyway, I think you're in the right place. So let's actually, put some color around that. So in terms of the correlation coefficient, as I said, you've got options. You can either do a scatter plot. Let's be honest, right? Let's stop beating around the bush here. That's just ridiculous. But as I said before, it's so important you understand that this is ultimately what, when you use the study here, this correlation coefficient study, that's what it's plotting. What Sierra chart, your institutional platform, it's amazing what it's doing, right? So let's look here. What I've got here, what I've done for you, and this will be, I'll give you this template, is I've built this myself, as in I've just, it's not rocket science, I've just put it together so I can interpret it. Is I've got the E-mini S&P, or the S&P 500 on the left axis, and I've got crude on the right axis. Can you see it allows us, visually we can start to see, look at that. Can you see the correlation there? You see them moving together. The red line is the crude oil market, and the E-mini S&P is the blue line in all of these. Okay, let's just focus on this chart. Okay, ignore everything else for the time being. Just focus on this. What is happening, right, is every single moment in time, according to how I have told the chart, so I've put here 60 minutes, every 60 minutes a new data point is being plotted. Okay, what Sierra chart is doing is it's internally creating a scatter plot exactly like this of crude oil versus the S&P 500, working out the correlation, and at that moment in time plotting it for me down here. Can you see correlation coefficient? Can you see it's between this goes up to 1 and -1, sorry, and that's 0. It will never go above or below 1. Why? You should be experts at this, because correlation it can only be 100% as a maximum, which we know is that. And we talked about it. Do you remember the tables I showed you before, where I said I don't necessarily agree with the exact breakage of the tables in terms of the correlation, where it's like, I can't remember exactly what it was, 0.5 is considered to be quite weak, above 0.5 to 0.7 is quite strong. I can't remember the exact break, and I was tempted to pull them out, but actually I'm not going to, because I think you should be very careful about that. I think you should learn from your own experience what you think is strong. To me personally, from my own observations, I think around 0.4 and above is a good relationship. Because you've got to remember those idiosyncratic factors, okay? There are going to be factors that are so specific to crude oil, to treasuries, to dollar yen, that are going to push it from pillar to post. You're rarely going to get, for a prolonged period of time, correlations of like 80-90%. It's just not going to happen, because every market is going to have such specific factors that only impact it and not the other market you're comparing it to. Like I said, the yen's going to be impacted heavily by the Japanese economy, and that factor is unlikely to impact the S&P so much. So obviously that's going to cause the correlation to naturally, consistently be quite a bit below 100%. It might be. So I think 40-50% is kind of the best you can hope for. Obviously there will be times you'll get higher correlations. But, generally, hopefully that makes sense. And, you don't need to take my word for it. Observe it, learn it, you'll see it anyway. Now, correlation can get extremely complex. It can get as complex as you want. Why? But it doesn't need to be. Why is that? Because think about it. You can plot correlation on a 60-minute basis. So what that means is every 60 minutes you get a new data plot. And therefore what? This scatter plot can be updated, right? You see the scatter plot. Every 60 minutes you get a new dot. Would you agree, right? If you put a new dot here and get rid of an old dot, the correlation is going to change. Do you see it might go up to 0.86? Then you put another new dot and you get rid of an old dot, 0.80. Then you get rid of an old dot and you put another new dot every 60 minutes. Can you see? 0.7. Oh. It won't move that much, but just trying to exaggerate the point. So that, you see this change, 0.86, 0.8, 0.7, etc., etc. That is what is being plotted here below. Do you see this? 0.8. Can you see it's changing from 0.8, 0.6, 0.4, sometimes it's 0. So the reason it can get complex is because what if you don't plot it every 60 minutes? If you plot it every 30 minutes, if you plot it every 10 minutes, if you plot it every day, it's going to give you obviously different results, right? This shouldn't vary dramatically, but obviously it will, because your scatter plot is going to have more granular or less granular data. Okay, that's obvious. So number one, you need to decide, how often do I want to calculate my correlation? Every 60 minutes, every 10 minutes, every etc., etc.? I actually don't think that's that important. Okay, if you want to set it to 30 minutes, that's fine. It's not going to make that much difference. You can experiment with it. Because every 30, every 60, it's all about the same, right? I stick to 60 minutes, no particular reason. I don't want every 5 minutes this to be calculated. It makes no difference to me. Why? Because I'm a contextual trader, right? I'm looking to make a decision, and then I'm kind of an intraday swing trader, right? You could call it. I'm not looking to know what the correlation is every second, right? It's just, I don't even know how you would trade like that. It will drive me completely crazy. I'm happy, if I'm looking to take a move out of the market, and we'll obviously have a look, I may be looking to hold it for 20 minutes, 30 minutes, 1 hour. I might take an hour to make a decision. I think the best way to relax is, to trade is to be more relaxed. So I might take an hour. A lot of you who've done the Pro Foundation will be very familiar with this. You do your hypothesis, you wait, maybe sometimes wait 20 minutes, take 20 minutes to do your hypothesis, wait 20 minutes, could be 40 minutes, 60 minutes before you take a trade. Then you really want to see if the execution of the hypothesis plays out. Can you imagine if this was being plotted every minute, 2 minutes, and it was constantly changing? It's going to be an impediment to you, because you're going to keep changing your mind. So for me, I've stuck on 60 minutes, okay? And I don't want to get into an argument whether it should be, 45 minutes or 30, or it's 60, okay? If you want to change that, change it. It's not going to make much difference. I found 60 to be kind of a happy medium for the type of trading I do. Obviously, if you're a very long-term trader and you're holding positions for weeks, you probably wouldn't want to use 60 minutes, because it's too granular. You might use daily. But I think for an intraday trader, and again from what I've observed of other institutional traders, 60 minutes is fantastic. You've got a bigger problem, okay, than this. It's basically how far back do you want to go? Can you see, am I looking to plot the relationship between crude oil and E-mini S&P? Let's say, this is really very, very important what I'm about to say. Let's say this is the market here, right now, okay? And I have, I'm not looking at the market live right now because I don't want it to be too distracting. You can see this is very, very, how do I say it, intensive, okay? So, see, I want to be looking at a static market so I can explain this to you properly. Let's say this was the market right now. The relationship is going to be different if you compare the last 2 days to if you compare this many days, right, from this point backwards. So all of these data points, you're going to plot them, right, on a scatter plot. How far back are you going to go? You know, do you want to go back 2 days? Do you want to go back 1 week? Do you want to go back 1 month? Do you see the relationship? It's very different depending on what time period you want to go back. You know, sometimes you can actually visually see here that the relationship here was quite positive, right? But then there's going to be other times like this where it's quite negative. Look, crude oil collapsed, whereas ES was going up here. Then there's going to be times where again it's quite positive. Look at this, crude's going up, ES is going up, right? Then there's going to be times where it's quite negative here. Crude oil's kind of going up, ES is going down, you know, and obviously you can have a look at this in your own time and you can eyeball it, right? You can kind of see, it's quite nice. I like to have them one on top of the other because you can really see how correlated markets are. Can you see? Very well correlated. But they're not always going to be positive, okay? Sometimes it's going to be negative, sometimes it's going to be positive. So you need to think about how far back do you want to go. Okay, so look, you've got to be very careful about this. It's almost like using these specific indicators people use and they say, hey, this is the best combination. There is no best combination, okay? You've got to use logic, and if your logic tells you that something different, that the setting should be different to what I have, you should go with that, okay? This is from years of experimenting and experience. I have come to the conclusion, and I'm going to tell you my logic, and I think you'll find it hard to disagree with, although of course you're welcome to, and if you do disagree with it, that's fine, okay? You've got to do what you think is logical. Don't be scared to do something different to what I say, but obviously, you know, you're paying me for my experience, and this is what my experience tells me. What I have done is, can you see this says 60 minutes? Can you see this setting, 24? So I have put correlation coefficient setting as 24. Okay, you can change it. Just go into the studies and there'll be a setting there. You can change it from 24. 24 times 60 is what? 24 hours. 24 hours. Sorry, my handwriting is awful. My missus always tells me, your handwriting's awful. How does anyone ever understand you when you're doing these lessons? I don't know what to say to her because it is pretty bad. 24 hours. So this first window here, so what I do is I give myself 2 windows of correlation. Just looks at the last 24 hours. Okay, so I want to know in the last 24 hours what's the correlation been like. Right, obviously it's going to be very sensitive. Right, of course it is, because it's constantly recalculating it on a rolling 24-hour basis. It only has 24 dots and they're constantly changing. They're very sensitive, right? Obviously. Why? Because there's only 24 dots. So if there's only 24 dots, an extra dot and then another dot and then another dot, it's going to have a bigger impact because there's only 24 data sets, right? Or data points, I should say. 24 hours, 1 day. That's my logic. I want to know, what's the correlation been like in the last 24 hours? What am I? An intraday trader. Would you agree with me? It makes sense. If you're an intraday trader and you're coming into the market, You want to know what's just happened in the last 24 hours, right? I think most of you will agree with that. So that's my logic, and it's worked very, very well for me. The problem is it's very sensitive, right? The correlations can change very, very rapidly when you're looking at a short window. Okay, so again, just to reiterate, what Sierra chart is doing is it's plotting a scatter plot of 24 data points of the S&P versus crude. It's plotting this, and then every hour it's putting a new plot and getting rid of the last one, 24 dots back, and then another new plot, and then one of these might be the old one, and then another one. And do you see it's got 24 at all times, and then it's working out the relationship, and then a new correlation number. Every hour it's giving the last 24. Okay, because it's only 24 observations, it's very, very sensitive. Can you see it jumps? Can you see this, right? Slow, pause it if you don't, go back, look at this, the correlation there, 80% correlation in the last 24 hours here. And you can almost see it. You can. That's why I like to eyeball it as well. It's nice just to confirm. Do you see how correlated they were in the last 24 hours? So do you see the correlation has been rising up to 80%? That's invaluable information for me coming into this session. And I'll show you how you can utilize that. You can see crude oil here. Then we can go to stage 2 and actually start watching crude oil and saying, right, I know the relationship now. Let me move this aside and let me now compare that on an individual basis. I.e., what's crude oil doing today? Is it, imbalanced up? Is it rotational? And so on and so forth. You can see it's got the VWAP there to help me determine the market condition. But for now, first I need to establish the relationship, right? Who cares what the market condition is if I don't know what the relationship's been like over the last 24 hours? Let's make sure I'm not covering anything. Yep, great. Now, like I said, it's very sensitive over 24 hours. You're going to make a lot of mistakes because the relationship can change in a flash. So you've got to be very careful. You've got to know kind of a little bit longer term what the relationship has been, right? Because the relationship can change a lot. A piece of news can come out, a fundamental shift can happen all of a sudden, and suddenly the correlation can go back. Or, do you remember what I said? A lot of times, institutional investors, so in fact, I'll come back to this, but in fact, let me tell you now. Institutional investors, right? They'll see the longer term correlation, which is this, is positive, but temporarily it's gone negative. They might see that as an opportunity to push the relationship back to its long run normal, right? So that's why it's good to know what the long term relationship is. Now look, my logic has always been, it's got to be related to the type of trader you are. I'm an intraday trader. There's no point me looking at the relationship over the last month, right? Because if the relationship over the last month was, say, positive, it's going to take an eternity for that to shift and reflect the new reality if there's a change. Would you agree? Because I've got so many think about it. This is why I said it's very sensitive over 24 hours. Because over 24 hours you've only got 24 dots on your scatter plot. If you go back 1 month, you've got 30 days times 24, right? So whatever that is, 600 or 700, just over 700. You've got 700 data plots. 700 of these data plots. Every single time a new data plot comes in, what impact is it going to have on that? Peanuts. If there's only 24 here, dots on your scatter plot, and when new data comes in, it's going to have a big impact. So I want to find something in between, right? I want to know, what's the correlation not been over a month? It's really not going to make that, because it's not going to change, right, on a monthly basis that much. By the time it's reflected, you'll see this will become so smooth if you start doing it over a month. This is not going to change, and it can actually be a little bit misleading, because I'm interested in the next day, what's the relationship going to be like between the S&P and crude, so I can take advantage of it today. So for the last month, I'm not really that fussed what the correlation has been, because it's probably going to stay like that and it won't reflect the reality of what's going to happen in the near future because of statistically having so many observances. So what I would like to do is find something, you know, more reasonable, the last few days. So this is where, again, I've just used logic. I've said, look, I'm looking over 1 day here. Why not look over 1 week? Would you agree that makes sense? You know, I mean, why would they look over 4 days, 6 days? And then people have all these arguments about 3 days, and I find it so ridiculous. I think just find something standard, like a week, and then be done with it, okay? If you want to use 4 days, stick to 4 days. Is it really going to make a difference? No. I think 5 days is really nice. It kind of captures what's been happening over the last week. It's fairly sensitive to new changes coming through over the last 2-3 days. Might take a little bit longer, obviously, for new changes to reflect, which you can see here. You see how it takes a little bit longer, whereas here it's very rapid, the changes. Why is that? Well, have you seen here? So if you think about it, this is hourly. If I want 1 week's worth of data, what do I want to do? I want 5 days. 5 times what? 24 hours. Okay, is what? 120. Okay, so 120 data points. So I want the correlation over the last 5 days. Okay, so what Sierra chart will do for me is it will plot, and hopefully I'm not blocking any of this, a lot more than 24. It'll plot 120, and it'll work out the correlation. Can you see the 120 is going to be a different correlation to 24? Because now I've got 5 days worth of data, the relationship's going to be different. Work out the correlation, and then every time a new plot comes in, it will then take off the old one, add in the new one, and change it again. But the changes are going to be slower because it's 1 new data point out of 120. It's going to take more to change the existing correlation. That's why the changes in correlation over 120 periods, i.e. 5 days, are a lot slower. This to me is perfect. I don't need to go back further. I don't need to. So it's up to you. I think this makes perfect sense to me. Let's look at the relationship over the last day and over the last week, and let's see how that's changing, and let's see how we can use that to our advantage in our trading, to look for disparities or look for where institutional investors might be seeing some relationships and then implementing that into their own trading. Okay, so that is pretty much it. You know, I could talk for hours about this, and you know, I don't want to do that to you guys, but I'm sure you can see that this is an amazing topic, and you can talk about it. But I think you can go into too much detail. I think this is enough for you as traders to understand what I'm doing. Right, basically, I'm looking for the relationship of the last 1 day, the covariance between 2 assets, the correlation. Remember, go back to this section if that doesn't make sense to you, but it should. Right? Oh, why it's not letting me click on that for some reason. Bizarre, it just wasn't letting me click on it. Yeah, so the covariance, the correlation, right? This relationship between 2 assets over 1 day and how it's evolving, and then over 5 days. So 1 week. 1 week and 1 day makes sense, right? That's my logic anyway. If I see there is a relationship, and what did we say before? About 40-50% correlation is a strong relationship, then I'm going to start looking closer at that market. Okay, if I see there's no relationship, for example, on this day, do you see it was a bit of a muddle, very difficult to make out what the relationship was, then I'm not going to bother looking at that market. Can you see this is brilliant? Straight away I know whether I want to bother looking at a market or not. And in fact, you can see it here very clearly, right? Can you see how the relationship over a week, okay, and I'm going to be honest with you, number one for me is, because the day tends to be quite volatile, the daily relationship, I tend to focus a lot on this, the longer term relationship. For me, longer term is 1 week. That's quite a long term relationship. Obviously, if you're a very long term trader, you can change these to looking back weeks, or even a month or 2 months, 3 months, etc. But for me, 1 week is quite a long time in my world. But it just kind of, it takes the noise out of it. Do you see? It's very hard sometimes. I've noticed this. Again, this is from my experience. Trying to make analysis when this is constantly changing. Okay, I like, if I'm thinking, trying to take a step back. You remember I said make sure I'm not blocking anything. Yep. I'm a contextual trader, so I want to incorporate into my hypothesis. Okay, and I'm not going to do it here. If you think, go back into the Pro Foundation course. If you haven't done it already, obviously you can go and do that. I did say before, I would definitely go back and make sure you've got an edge, right? And that is important to say. I'm not here to say to you, hey, you've got correlation now, you can buy and sell based on correlation. That's very dangerous. You need to have a hypothesis, obviously, whether that's using market profile, VWAP and order flow and so on, which obviously I do, which you'll find in the Pro Foundation course. And a lot of you that are watching this, you've already done that to death, and you should have. You should have a really good, solid basis of an edge. This is a layer on top, okay? So correlation really comes in, if you think of context, where you've got order flow, VWAP, maybe you've got market profile, and then down here you've probably got, terrible drawing, but correlation will come in. Probably goes in here somewhere. But you see in the hierarchy, it's just a layer, okay? The point is to make it a layer, you need something a little bit stable to really make decisions on, right? So when you come into one day, for example, you want to be able to see, oh, I see the relationship on this particular day. Recently, it's been quite positive, right? And can you see, you can actually see here, it's turned positive. Do you see the relationship is positive? When the S&P in the last few days has been going up, crude oil has been going up. Okay, when the S&P has been going down, crude oil has been going down. All right. Now here in this area, we lost the relationship. This is another reason I love to use correlation and look at it, because with the naked eye, it's very hard to tell. Sometimes it's easy. Here you can say, oh yeah, okay, yeah, it's been positive. And you can see it starts to become positive. Can you see? When crude oil was collapsing, S&P was collapsing. So what happened here? The correlation started to rise and become positive because the markets were moving in tandem. Look here, it became such a mess. It's actually very, very hard to tell. And can you see correlation started to drop off again. So for me, I'll be honest with you, I don't really look that much at this. I just have this here, you need it. Sierra chart needs the data to plot it as correlation, so I might as well look at it, that's fine. But I do like to focus more. We said it before, right? Do you remember when we were doing this exercise? It's very hard with the naked eye sometimes to be able to tell the strength of correlation, how good is the relationship, especially, markets are not generally like this. This is very strong correlation. Generally the markets are more kind of like that if you're lucky, when the correlation is good. They tend to be more like this, with outliers. Be very careful. I was going to say this before and I didn't. Just remember, as good as the relationship is, you will get outliers, all right? So obviously don't bet the house on everything on this relationship holding. That's the whole reason why it is 60% sometimes, because you do get outliers, all right? And be prepared for that. Go in, obviously be sensible with, how much risk you're taking and so on, because sometimes obviously a relationship can break apart. But at the same time, give yourself the best chance of success with correlation by only using it when the market is highly correlated. Days like this, can you see here where the correlation is, it's virtually zero, it's like below 20. Days like this, I'm not going to look at crude oil. Okay, I'm not even going to bother looking at it. That is, I would say, my final point. Okay, is what I like to do on any given day is I will, and hopefully this now makes sense to you. I won't look at this first, I'll look at this. And when I'm writing out my hypo, and again, I'm not going to really do that here because it's, we'll be here for hours, and I've built the whole Pro and Foundation course for that. When you're doing your hypo, your CVA, and your market condition and this and that and whatever factors you're looking at, even some fundamental factors. And then when you come to do correlation, okay, ask yourself over the last week, what has the correlation been? You know, oh, it's been negative for a consistent period of time, 5 days. Right, I'm going to look at crude oil today. Then what you can do is you can then have a look at, okay, what's happened overnight, correlation-wise. Does that make sense? So I like to typically look at this correlation coefficient because, as I said before, it's very hard with the naked eye. Yeah, it's nice sometimes, you know, and obviously I see people doing it and saying, hey, you know, obviously the correlation is positive, you can see it, and that's fine. There's nothing wrong with that, but, you know, if you want to take it to that next level, right, and really take it to the next level and see what institutional players are doing, which you can see it's not particularly complicated, right? They're just looking at this. That's why I spent so many hours teaching you about covariance. This is all they're doing. They're looking at the covariance in a single number, because obviously these data plots are being plotted in a scatter plot. I've said it a million times. And then the software is telling you the strength of this relationship rather than you having to really eyeball it. I really don't sit here and eyeball this, and sometimes it's nice just to do it for fun, but the reality is I want to know what is the relationship. Is it strong? Is it negative? Is it positive? Right, so when you're doing your hypothesis, obviously with correlation, positive, negative, neither, and then a strength. Okay. I would say anything below kind of 0.3, don't bother. Less than 0.3. Again, it's not an indicator. If it's 0.31, you know, that's fine. You can still avoid it. Right? It doesn't have to be 0.3. I'm just saying roughly below 30%. You will find the relationship is quite weak. You know, you're just putting yourself in that position where you're relying on crude oil to do something, 30% strength, and it suddenly does something different because like I said, those idiosyncratic factors are very strong, so that kind of macro correlation isn't there at the time, right? So my view is, why put yourself in that position? Just ignore it, right? Just go back to your, you know, your main hypo factors, whatever they are, and place more emphasis on those. When the correlation is very strong, obviously you can incorporate this in and place a little bit of emphasis more than you usually would on correlation, right? Now, what I'm not going to do is explain all of that for dollar yen, right? Because you can see it's exactly the same thing, right? You can go and rewind it. I would recommend watching this several times because I think it's that useful for you. Hopefully you find it useful as well. And don't worry, we're going to have a look at, you can see some of my actual trades that I have taken on my live account here. Which I'll show you how I incorporated correlation in one moment. We'll have a look at good few examples, 5-6 examples, to see how I incorporated it. But the point is, it's just exactly the same here. Dollar yen. Can you see I'm looking at the relationship between dollar yen and the S&P? This is crude oil and the S&P. I've got the same correlation. So over the last 24 hours, correlation between UJ, dollar yen, S&P 500 versus dollar yen, S&P 500 versus crude. Do you see, it's really nice because what you have now, you know, money is just flowing from one asset to the other. Ultimately, that's what's happening. Across different asset classes, institutional players are obviously, you know, taking risk, and that tends to be across FX, commodities, sorry, terrible spelling, handwriting, keep saying it, and treasuries, like money markets, you know, just bond markets, you know, more like interest bearing instruments. So things like treasuries, then you've got equities, you've got FX, and you've got commodities. See, we're covering a broad spectrum here really nicely. So typically, like I said, same sort of thing, 24 hours, 1 week. What's the relationship being between UJ and S&P? Sorry, my handwriting. S&P, I does say S&P 500. S&P 500 and crude. and then S&P 500 and US Treasuries. Same thing, the relationship. What's the relationship? What's the relationship? And honestly, that is what I'm doing, okay? You know, I don't want you to use it as an indicator. I do want you to go through all the exercises, understand all the statistics behind it, because I don't want you just to, IMV said when this is above 0.4, I should use it. Don't do that. Obviously, understand why. Ultimately, that is what I'm doing, but I understand to the nth degree why I'm doing it. So when I do break it down to its simplistic bare bones, I'm not just blindly following what someone told me to do. You see, that's a recipe for disaster. I understand it inherently, deeply, you know, to a very high level. Understand what this is. When this goes down, it's the scatter plot dynamic is changing. The covariance is changing. The correlation is changing. I know it's over 5 days. Okay, fine. What markets is this? Dollar, yen, ES. All right. Let me see. Can I actually take advantage of that? So again, same sort of thing. If I see dollar yen, you see that very nice relationship. If dollar yen is around here on a day, I am not going to even look at dollar yen on this day. Okay, straight away, can you see? It's below 20%. It's just, there's no correlation over the last week between these markets. I'm not even going to bother looking at that. I'm not even going to start digging deeper. Dollar yen is out of the question on this day. Right? Dollar yen starts to get, look, negative, strong negative relationship over the last week in this region. Do you see? End of kind of June, July. Well, for me, obviously, I don't know when you'll be watching this, but end of June, July. Wow, good relationship here. Negative. Nice negative relationship. When the S&P's been going up, dollar yen's been going down over the last week. Okay, so maybe I can take advantage of this. All right. So I think that has explained it to the nth degree. I'm going to give you this template, so you have all the correlations. Okay, you know, organize them as you wish. I don't actually keep this open in front of me all the time. I will first, like I said, decide which one has correlation I can actually use. I'll obviously probably split this out now because it's been going on for over an hour. I'll split this out into a second section and then we'll be done, where I'll actually show you some executions and how I used it, which you're going to find very practical and actually quite straightforward for you to start using as well and incorporating. And it's really it's not giving you a new edge, as I said before, in terms of the hierarchy. It's going to enhance your edge, in my opinion, dramatically, if you use it correctly. Okay, it's not every day that correlations exist. You can see correlations change over time. Sometimes there's no correlation, all right, and then don't use it. Actually, it's going to be a disaster. You're going to be looking for something that isn't there. This is just as powerful in helping you know when to use correlation as it is to help you know when not to use correlation. Hopefully you can see that. So obviously be mindful of all those things I'm saying. But what we will do is I'll show you exactly how I utilize this in obviously my trading. But what I just want to do before I end this section is I just want to mention something about the US Treasury. Okay, I do not, and this is up to you, I'm going to leave this there for you. If you want to look at the Treasury, you can. Okay, I do not look at correlation between the S&P 500 and the Treasury on an intraday basis. I look at it more on a longer term basis, you know, more because obviously things like the FOMC and, you know, they're driving the yield curve and so on, but it's going to have more of a broader impact, okay, over the next week or 2 weeks, and you've seen that, especially a lot of the fundamentals, they'll take time to come through. You know, when we're trying to move away from, and I hate to say it, but it's true, that retail style of trading where you just open the calendar, oh my god, this has popped up, yeah, let me suddenly make a decision because this data has come out, and oh my god, you know, let's not, you know, that's not how professional traders do it. It has to be calm, collected, and analytical. What I find with treasuries on an intraday basis is they don't allow you to do that. They don't allow you to be calm, collected, analytical. In fact, if anything, I found them to be pretty unhelpful. Okay, and the reason for that is, and I'm not actually, I've got this here. Okay, I just did this just so I could speak to you about it. I don't actually look at this that much. Most traders like to look at not the treasury price, but the actual 10-year yield, right? So as you know, the price reflects an interest rate. This interest rate doesn't change that much on an intraday basis. That's my point. Can you see here, over the last 3 days, it's barely gone up or down a few basis points, okay? It just doesn't change. Look here, for over a week, the market barely moved. So I find it quite distracting, okay? Do you see, it just doesn't allow you to be more relaxed and say, hey, you know what? There's a relationship here. Because I just find it, I wouldn't say stressful. Stressful is a little bit of an extreme, but I just find it that doesn't give you much on an intraday basis. I find over a long period of time, it's great. You know, over a week or two, obviously if you're looking at policy and you want to see how that's impacting markets in general, fantastic. But in the moment, you know, I'm about to execute, okay, where is crude oil? Where is dollar yen? I don't sit here and think, where's the treasury market? Why? And a lot of you know this, especially if you understand the markets now, and you should if you've done Foundation Pro courses. Do you remember when you did the foundation course and you were looking at the treasury market? It was very slow, right, as it moved. And in fact, I've got it here. Don't ask me why it's green, but the VWAP. Do you see it's very jagged? It doesn't move much. It's a very thick market on the depth of market, right? It's got a lot of bids and offers, right? It's got a lot of supply in the market. There's a lot of people sitting on bids and offers. It's a very slow market on an intraday basis. Hopefully that makes sense. Why I find it just not that useful, if I'm honest with you. Obviously that will come from experience, and you can try yourself. Intraday basis, it just doesn't move much. What am I going to get out of it? You know, it isn't. And so that's number one. Number two is it takes up space, right, as well. You're going to see in a moment, I've already got all my contextual tools I'm looking at, maybe order flow, maybe the S&P 500. Suddenly, now I need to introduce a crude oil chart. I need to introduce a dollar yen chart. I need to introduce a correlation chart of dollar yen versus the S&P, a correlation chart of crude oil. Do you see? If I start also putting treasuries in, it starts to become a massive mess. So, I realized, obviously this comes from experience, you don't know until you try. When I was looking at treasuries, it wasn't giving me anything. And it was actually like, you know what? It's actually got a double positive effect. Let me just get rid of what I don't need off my charts. Now it's up to you. I've given you the basis. You can start looking at S&P versus gold. You can start looking at S&P versus anything you want. Or your market versus, you can even start looking at it versus crypto if you want to. I've said it many times. You know, I really want to deliver value to you. I want to share my experience with you because, you know, who's going to do that? What institutional trader that has spent years working in institutions is just going to tell you? They're not, right? Whereas I want to do that. So I'm going to tell you, basically quite bluntly, that over the years, I have found dollar yen, I'll tell you categorically, and crude oil to be the most effective when it comes to intraday correlation. Why do I think that is? One of the big factors is crude oil is one of the biggest speculative markets after the S&P 500 when it comes to futures volumes. Treasury market also, but it's so thick, right? It's a different dynamic. It's a how do I say it? It's a bond market. It's an interest bearing instrument, right? So the factors that drive the treasury and the nature of the instrument, it's an interest. It's people are using it more to gain yield. You see, the price isn't going to fluctuate. Whereas crude oil, obviously we know, is a different dynamic. It's going to fluctuate a lot. Dollar yen is a financing currency. I'll talk about that later. So very, very popular currency to use for financing S&P purchases, asset purchases. It's also got the dollar, obviously, most influential currency and economy in the world. So I found dollar yen to be incredibly useful, especially when you're trading the S&P, and heavily used by many, many investors to look for these relationships to hold. A lot of it is to do with financing, which we can talk about later, because yen does have a cheaper financing rate, so people do tend to like to borrow or kind of borrow yen, and then sell the yen and buy, and we can talk a little bit about that later. but there is a very strong kind of structural relationship between dollar yen and the equity market. And then crude oil, again, like I said, we know it's heavily, it's got a lot of volume basically and very popular. Futures market, similar to the E-mini, so there's a lot of algorithmic volume. Algorithms are playing the crude oil market versus the E-mini S&P. Arbitrage, there's a lot of models that actually incorporate both. Because what it is, right, if you're an algorithmic firm, you want to execute in markets where there's a lot of liquidity, right? It makes sense. You don't want to get caught in thin markets where, you know, you be flying around everywhere. You want to make sure you're executing markets that are easily accessible. Crude oil, obviously very accessible and volatile, so opportunity. And then S&P as well, so it makes sense, right? I've said enough to death. So for me, these two are absolutely the best markets, okay? And that is what I'm looking at. So what we're going to do now, obviously take a break, go and watch this again, and I'm just going to finish off pretty much most of I think then we'll talk maybe for a few minutes at the end in a third section about the reasons for correlation, which a lot of it I've just covered now anyway, talked about the financing and things like that. But yeah, we're going to spend a little bit of time in probably part B of this section, just having a look at some executions.